Hi there, and welcome back. In this session, we're going to dive into the world of earned income, what it is, how it's taxed, how to report it correctly. Whether you're an employee, self-employed, or somewhere in between, maybe a combination of both, understanding earned income is the key to mastering your tax strategy. So let's get started. So first, what counts as earned income? Well, first, your wages and salaries. This is, what you might have been getting as your regular paycheck if you work for an employer. If you're on payroll, whether it's your own payroll or somebody else's payroll, this is likely your main source of earned income. So if you work in hospitality, you might receive tips. If you're in sales, you might receive commissions, bonuses. These are all considered earned income and have to be reported, whether they're reported to you directly by your employer or they're simply paid to you in monies that you receive for contracting. Those are funds that are taxable to you on your tax return. Also, sales commissions that are paid to professionals, these are actually declared as income in the year in which they're paid. So, for example, if you have a sale in December, you're paid in January, that's taxed in the following tax year. And this doesn't matter whether you're a sales professional that's paid on commission, a physician who's paid based on RVUs. These are all considered taxable income. Also, any type of bonuses that you're paid are also considered earned income, whether they are for, performing certain numbers of procedures, for selling a certain number of products, anything like that. That's all considered earned income. Also, key component, self-employed earnings. So if you run your own business or you're a freelancer, your net profits are considered your earned income. Also, just some other things that we're going to include in here. I'm not going to go into great detail on it. If you're a member of a union and your union goes on strike, any payments you receive there also earned income. Also, for anybody that might be on long-term disability benefits, if you're retired or if you're less than retirement age, let me rephrase that, these may be treated as earned income depending on where the source is that they're coming from. So if you're actively working, it is probably considered earned income. So let's talk about how earned income is taxed. So first and foremost, we have federal income tax. This is a progressive system in the United States, meaning the more you earn, the higher your tax rate. Our tax rates in the United States range from 10% to 37%, and they're classified by different categories: single, married filing jointly, married filing separately, head of household. All have different types of tax ranges, and that all impacts your marginal tax rate. Then we have state income tax. Most states in the United States have a state income tax. These rates can vary widely. Some states have flat rates, other states are progressive, like our federal system, and a few states like Florida, Texas, don't have an income tax at all. Then we have payroll taxes. These fund Social Security and Medicare. If you're an employee, which means you receive a paycheck and W-2 wages, you pay 6.2% for Social Security and you pay 1.45% for Medicare. If you earn above a certain threshold, there's an additional 0.9% Medicare surtax. This also comes into play later, and I'll reference that when we get to that section. Then we have self-employment tax. If you're self-employed, you get the privilege of paying both the employee and the employer portion of the payroll tax, which is a total of 15.3%. The good news, if there is any, is that you can deduct half of this when you calculate your income tax. Let's talk about withholding versus estimated tax payments. If you're an employee and you're on payroll, or if you're self-employed and you run your own payroll, you'll usually have taxes withheld automatically. But if you're self-employed, you're going to need to make quarterly estimated tax payments to avoid penalties if you are not doing payroll tax payments and federal and state income tax payments by way of your payroll. Please make sure you understand how these layers work. This will help you better plan and avoid a surprise come tax time. Now let's talk about how you're going to report this earned income. Employees. If you receive a W-2 from your employer at the end of the year, it's pretty simple. It shows your total wages and how much tax you've earned, how much tax was withheld, versus how much money you earned. If you're self-employed, this is going to be a little more complicated. You're going to have to file either a Schedule C, which means you're a sole proprietor or a single member LLC, or you'll have to file a business tax return. Let's just assume you're a Schedule C. You'll file a profit and loss statement, which is your income versus your business expenses. This will then generate your net profit or loss, which will then go into calculating how much self-employment tax you own, and then also how much federal and state income taxes you might owe. Even if tips aren't included in your paycheck, you are still required to report them. The IRS expects accurate reporting, and under-reporting can lead to penalties. As I tell people all the time, there's a great deal of difference between tax avoidance and tax evasion. Avoid tax evasion at all costs. Keep good records throughout the year. This will make the process that much simpler when it comes time to filing your taxes. So there you have it. Earned income in a nutshell, and knowing what counts, how it's taxed, and how to report it can save you money and stress. Whether you're an employee, an entrepreneur, or somewhere in between, maybe a combination of both, this knowledge is a powerful tool in your tax strategy.